So as we heard, Iran's top security body is considering whether to close the important Strait of Hormuz. Iran's parliament voted to shut it down after the U.S. strikes. President Donald Trump today called for the U.S. and other oil-producing economies to pump more oil as crude prices remain volatile following the U.S. strikes in Iranian nuclear facilities. And joining us to discuss what that would mean for you is Daniel Lacalle. He's the chief economist at the Tresses Hedge Fund and the author of The Energy World is Flat. Daniel, great to see you. Thanks for coming on.
Thank you so much, Paul. Thanks for having me.
So, Daniel, an estimated 25% of the world's oil passes through the strait, an enormous volume. How would closing the strait affect energy prices here in America and perhaps around the world?
Well, obviously, it would have an impact, but we must remember that 70% of the oil and gas that pass through the Strait of Hormuz is actually going to China. So the most severely impacted would be the Chinese economy and the Iranian economy, because let's remember that also in the case of Iran's oil exports, China buys 90% of them. No? So I think it is important to understand the very significant impact to Iran's own allies and trading partners, because through the Strait of Hormuz, almost only 4% of U.S. imports are coming from that, pass through that strait. No, and in the case of Europe, it's about 9%. So it would have an impact, obviously, because of relatively higher prices. But I think that the market has already discounted that this is more talk than action, because in the past, I've lived 23 occasions in which Iran has announced that it would shut down the Strait of Hormuz, and obviously it didn't happen. It has never happened, in fact.
Of course, if the Chinese regime, who is closely allied with Iran at the moment, did not want them to do it, perhaps it will become even less likely to happen.
Absolutely, absolutely. Think about this. OPEC, I think it's important to understand the following timeline. The International Agency of Atomic Energy published a scathing report on Iran, stating that Iran is not complying with its commitment to non-proliferation in nuclear energy. Immediately after that report, what we saw was that OPEC Plus announced 3 consecutive increases in production that coincidentally amount to all of the exports of Iran to the rest of the world. So I think that OPEC Plus was already preparing itself for some kind of disruption with Iran and generating at least a level of confidence in the market that supply would not be disrupted. But we must remember at the same time that China, being the largest importer of Iran crude oil and being one of its few financial and strategic allies, would be very negatively impacted, not only because of the disruption of supply, but also because of the inability of the Iran regime to repay the enormous amount of debt that they owe to China because of support, for example, in these works in this enormous infrastructure of a train railway that goes from Iran to China. All of this is very significant. And I think it would be akin to shooting yourself in the foot, as the previous analyst was saying. The most negatively impacted would be the Iran economy itself. It would lose billions of dollars of oil revenues, but also it would very, very negatively impact its credit capability with the enormous amount of loans that they owe to China.
So perhaps something more symbolic threat than anything. Daniel, you manage over $1 billion of assets at the Tresses Hedge Fund. We see that stock markets around the world, including here in the U.S., they didn't really flinch after the U.S. attacks on Iran. Stock indexes have actually risen today. Why is that?
Well, I think that there's a few reasons. I think that the market understands that the Iran regime is completely isolated and that its neighboring countries are not going to help. In fact, the reason why oil prices are plummeting today is after Iran decided to attack an empty base in Qatar. No? So a lot of people are starting to discount that there's a lot more bluff than actually ability of Iran to retaliate. No? Additionally, I think that many of those neighboring countries understand that the risk globally was Iran's nuclear capability added to the announcement recently made by the Iran regime of increasing its military expense by 200%. So the risk of having more than 400 kilos of uranium heavily enriched that is obviously feared could be used for the equivalent of 9 atomic bombs, and at the same time a very significant increase in its military expense that is clearly also a threat to many of the Sunni countries because they know that Iran wants to impose some sort of a caliphate that is ruled by the Ayatollahs. All these things have led to the market understanding that there's very little risk of escalation to a regional or even a global war. And the fact that China and Russia have been criticizing, but very mildly, the attacks on the nuclear facilities are also signals that this level of risk, of geopolitical risk, was not likely to escalate to a level that would be considered a threat to the global economy.
So you're saying that investors were more worried about Iran's nuclear capabilities than they are about an escalating conflict in the Middle East, and perhaps destroying these nuclear capabilities actually relieved investors' concerns in some way?
In many ways, yes. A lot of investors were not aware of the rising and accelerating threat of Iran's nuclear program. That has been, let's say, widely evident once Israel attacked, and suddenly the news of these 400 kilos of 60 to 90% enriched uranium came, and obviously people that were not aware of this report published by the International Atomic Energy Organization, suddenly started to read it. And when you read that report, you start to understand that the risk is not what is going on right now, that the risk is not to have stopped it in the first place. So a lot of the initial reaction of markets came without understanding the significant implications of the resolution against Iran of the Atomic Energy Organization, and and understanding as well why had OPEC Plus announced such a massive increase in production in a time where very few people understood it. I believe that we discussed this actually at some point, that nobody understood why OPEC Plus had agreed to 3 consecutive 400,000 barrels a day increase in production in an environment of global demand being relatively weak, etc. Now everybody is starting to put all those things together, and investors are starting to understand that the risk was inaction, not the current level of action.
Daniel, I'm sure you have clients calling you as all of this unfolds, worried about this and worried about that. How do you go about protecting your retirement savings in a geopolitical environment like this?
Well, I think that everybody is starting to understand that the best way to protect yourself against geopolitical risk premiums and volatility in markets is, number one, not to follow the headline trends that may be created, i.e., the people that jumped on the energy sector, the people that jumped on commodity, expecting commodities to go through the roof, are today obliterated. No, so the number one thing is to hold gold. The number two thing is to avoid sovereign debt, which would definitely had been very severely impacted in an environment of global repositioning and global weakening of, let's say, the historic relations between countries. And the third one, obviously, is to try to avoid those stocks that are too cyclical, that depend on a very aggressive improvement in economic growth or a very rapid improvement in consumption. So things that are stocks that are very related to or impacted by trade growth, etc. So it's basically just being less. It's interesting because the two riskiest part of the investment spectrum in this environment are the allegedly lowest risk asset, so sovereign debt bonds, sovereign bonds, and on the other hand, the other part is obviously those that look like they're going to be seeing a very significant change in a trend, like oil prices, which have been very weak since 2022. And obviously, nothing in terms of supply and demand was suggesting the recent spike. So it was very dangerous to follow the trend and, let's say, taking aggressive positions on that change of trend.
Daniel Lacalle, Tres's Hedge Fund. Daniel, as always, thank you.
Thank you very much. A pleasure.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.